This is Will McCauley with cEntellect. I'm going to discuss this week's proprietary research and analysis piece on crude oil. Specifically, we're going to look at currency demand destruction in emerging markets. Everyone, I think, has heard that a number of emerging markets have seen severe devaluations in their currencies year to date, and we want to walk through the impacts on those importing countries, compounding that currency devaluation with the rise in Brent prices that we have seen. For the takeaway, we expect around 500 to 900,000 barrels per day of demand destruction driven by these currency impacts. For reference, the global market is around 100 million barrels a day, so you're looking at 0.5% to 1% demand impacts. Not a huge number, but still significant for these particular countries. So the first chart we want to look at is the total local currency crude price impact by country. So the bottom chart that you are seeing here, the bottom line, the copper, is the 39% increase in Brent price. That is across the board, the same impact for everyone. The black line is showing you the impact from currency devaluations and what that compounding effect does for the price of crude oil in local currencies. So obviously Turkey has been in the news, has had a significant devaluation in its currency. So Turkish imports of crude oil are significantly more expensive than they were previously. The opposite is true for crude exporters such as Russia. They appreciate the currency devaluation because they're getting more rubles for the same dollar. So it's benefiting them, but most of the importing countries are negatively impacted and sometimes significantly. You can see the other markets on this chart as well. Brazil has a 36% devaluation in currency, Pakistan 27%, and on down the line. These are the biggest currency movers and some of the biggest emerging market importers. The next chart that we are going to look at is taking some numbers that have been announced by countries and expanding that analysis to come up with a total global impact. So you've seen Pakistan already has declines of 6% crude imports year on year, driven mainly by its currency and by the Brent price increase. If you extrapolate that decline to the other emerging markets that I show here, this is the estimate by country of what the demand destruction is driven by, again, price increases and currency devaluations. India has signaled, it hasn't come through the numbers yet, that they are going to start reducing imports as well due to the prohibitive costs in local currency for those imports. So again, summing this up, depending on which countries you look at, obviously India and China are the biggest importers, although their currency has devalued less. The impact to the global market is much larger by those two countries. So India, we're forecasting around 350,000 barrels a day. And China around 490, 500,000. So again, estimating somewhere between 500,000 to 900,000 barrels per day of demand destruction driven just by currency. For our full research and analysis piece, please visit us at cEntellect.com.